Well, stocks a little mixed this morning with the Nasdaq and S&P looking to continue momentum after posting 10 straight days of gains. The rally sparked by expectations that the Fed will cut interest rates next year, but our next guest says those very expectations pose one of the biggest threats heading into 2024. For more on this, let's bring in Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist. Jeffrey, good to talk to you today. What's wrong with great expectations going into 2024?
Well, I guess the problem is there's so much priced in, right? We're looking at 6 rate cuts from the Fed, 6 rate cuts from the ECB, and now even maybe 6 rate cuts from the Bank of England. That's a high hurdle. It's helped to drive the stock market up 16% since late October, but it's pricing in a lot of optimism. I'm a little concerned that inflation won't prove as passive as many of these the markets and maybe even some of the central bankers are thinking. Inflation has historically come in waves. We could see that in the 70s. We could see it in the 80s, even in the early 90s when inflation picked up to 5% in countries like the US, the UK, Canada, and Australia. We saw subsequent waves, meaning that inflation goes up, comes back down again. You can see on this chart, the blue line there, the history in the 1970s. The purple line is this experience here for the US, but it's not just the US that looks this way. Most countries, when they see a big wave of inflation, they get a subsequent wave. Now, I don't believe we're headed to new higher levels of inflation, but I think there are a number of reasons why it could prove volatile in the year ahead. First of all, we've got potential supply chain problems, both in the Panama Canal and in the Red Sea. We've got energy issues that may crop up next year. We've got a number of different challenges, I think, in housing and a few other areas that could create some volatility to inflation that would keep central banks from cutting on the aggressive path the market has already priced in.
And Jeffrey, when we look at how investors are looking at these rate cuts coming up next year, is it a case of the risk being more that the markets are getting ahead of themselves, or really underestimating the risk of why the Fed might be cutting if it's related to perhaps weaker economic activity?
Yeah, well, you're right. It could be a little bit of both. I think we will see some weaker economic activity in services. Taylor Swift saved the economy in 2023, but it'll be hard for her to do that again in 2024, simply because all of the entertainment and travel spending that we've seen boom in the U.S. and, Time Magazine's Person of the Year was certainly the U.S.'s most valuable person of the year as well. But as we look to even beyond the U.S., in Japan, they saw the biggest tourism money coming into the country, most tourist receipts in terms of income they've ever seen in that country. So it was a big boom in travel and entertainment spending. That is on a path to slow in 2024, even as maybe manufacturing begins to stabilize. So your point is a good one. The economic outlook for the rest of the world is a pretty soft one next year, along with earnings growth. We continue to see earnings being revised down here for the fourth quarter. And that all comes together to a market that's really been pricing in maybe a Goldilocks outcome of still relatively robust economic growth and aggressive rate cuts.
Jeffrey, you mentioned Japan there. We should remind viewers, this is the one major central bank that still has negative interest rates in place. You heard the BOJ governor yesterday sort of quiet any expectation of a policy pivot, but it sounds like you think that could be a little different going into next year. What's the risk if we see a tiny hike, maybe back in positive territory here with rates coming out of Japan?
Yeah, it wouldn't take much, right? It'd be the first one, though, in 17 years. And that could offset some of the excitement over other major central banks cutting. First of all, Japan has been a major source of investment funding to the rest of the world. Japanese investors hold over $3 trillion of investments net outside of Japan, meaning they've invested $3 trillion more outside than foreigners have invested in Japan. That includes more than $1 trillion in U.S. treasuries. Any rate hike over the next year could prompt Japanese investors to sell foreign assets and bring them home, a move incentivized by a stronger currency, higher interest rates, and what's already a 27% gain in Japanese stocks this year. So there are a number of reasons why you could see a sell-off in foreign assets as all that money, maybe not all that money, but even a portion of that money comes home on the outlook for better returns domestically.
So as we look at some of the different actions that central banks are taking, I know you also note what we see with Canada, Australia, as well as UK with that surprise inflation drop coming again in November then. What should people look at when they're thinking of the risks that could upend the central bank getting to its 2% target?
There are a number of them, and I think a very tight labor market is something that I don't want to set aside here. The fact that we continue to see wage gains, even in a country like Japan, where inflation has remained so low for so long. You had Nintendo put in a 10% pay increase, Toyota, Honda 5% pay increases, Uniqlo, its parent Fast Retailing, talking about up to 40% pay increases. These are sticking, and this is something that the government wants to see in Japan. So it's encouraging businesses to increase wage gains, but we've seen it around the world. And I think that is one thing that could remain sticky with regard to inflation. I mentioned the transportation bottlenecks, but we haven't seen supply chain problems in a couple of years, but the Panama Canal moves 40% of world cargo traffic. And moving through the Red Sea, the strait there, the Bab el-Mandeb Strait, moves 12% of the world's cargo and oil. So these maybe 50% of the world's cargo traffic being blocked up essentially by February could mean some shortages begin to develop and support prices. So there's a variety of factors out there. I'm not saying they're my base case that inflation shoots back up again, but I think the market completely discounting any possibility of that is going a little too far.
We'll certainly be continuing to track that. Appreciate you joining us with your insights. Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist. Thanks so much.